Joining us right now as we count down to the opening bell on Wall Street, Kevin Mahn is the president and chief investment officer of Hennion and Walsh Asset Management. Good morning to you. You saw the PPI number. We just had a conversation with Mr. Kaplan about what the Fed may or may not do. Layer on top of that, all the issues we're seeing taking place in Israel. What do you do?
You know, Andrew, I was somewhat comforted by Mr. Kaplan's comments in the previous segment because my fear right now is that today's PPI report, which came in above expectations and will likely be followed by a similar CPI report tomorrow, will lead the Fed into believing they need to do more and raise interest rates again this year. If they do that, I believe that they risk pushing this economy into a deeper and more prolonged recession than would have otherwise occurred on its own earlier next year, given the impact of those high interest rates on an over-leveraged government and an over-leveraged consumer. A consumer that now has over $1 trillion on their credit card. A consumer that's now facing credit card interest rates above 24%, the highest on record. A consumer who now has got into early delinquency status on those credit cards at the highest pace in the last decade. And of course, a consumer whose personal savings continue to dwindle. If the consumer stops spending, the economy will slower. The ultimately lead into a potential recession in the first half of next year. And then the Fed is going to have to come to the rescue, perhaps with more than the 50 basis points in rate cuts that they're currently forecasting for next year.
So, but that also suggests that things get really bad and that they have to cut. Right now, I think Kaplan's saying things are actually going to have to get tightened up a little bit more.
Yeah, if you look at the Fed's own estimate, they believe the economy will continue to grow this year and actually exceed their earlier expectations. But if I look into next year, Andrew, they're forecasting GDP growth of only 1.5% and GDP growth staying below 2% for the next 2 years after that. They also forecast that inflation will remain above their 2% target for the next 2 years. Yet over those next 2 years, they're forecasting, as it stands now, 50 basis points in cuts next year and 120 basis points in additional cuts the following year. The Fed doesn't cut interest rates if the economy is doing well. They cut interest rates to help stimulate the economy. So I believe investors should start positioning their portfolios, being more defensive over the next 6 to 9 months, but getting ready for the ultimate turn in the market when rates are lower, when yields are lower, and inflation ultimately is lower. Our research shows that there's 3 sectors they should look at: consumer staples, information technology, and of course, staples.